Okay, so you want to own a shopping mall. It feels like the safest business in America. It's not. 87% of America's malls could shut down in 10 years. And a dead mall sells for 43% less than its owner paid. By the end of this video, you'll know how a mall makes money, why one store leaving can drag down 50 others, and why the person who profits from a dying mall is almost never the one who built it. That's exactly the kind of thing this channel exists to unpack. Subscribe for more breakdowns like this. Let's start with what it costs to get in. Here's the first thing that surprises people. There are two completely different prices for the exact same kind of building, and which one you pay depends entirely on timing. Say you wanted to build an enclosed mall from scratch today. You'd be looking at construction costs somewhere around $150 to $190 a square foot. That includes the steel, the HVAC, the parking structure, the retail shelves for tenants who haven't signed yet. For a mid-size regional mall, around 600,000 square feet, that puts you between $90 and $114 million, and that's before a single tenant signs a lease. Nobody builds these anymore. Fewer than 10 enclosed malls have opened in the United States this entire century. The math on new construction almost never works. Think about what that means for a second. An entire category of American building, the kind that once defined a generation of Saturdays, has essentially stopped getting made. Every enclosed mall you'll ever walk through was very likely built decades ago by developers betting on a version of retail that doesn't exist anymore. So here's the twist. Nearly everyone who buys a mall today isn't building one. They're buying someone else's mistake at whatever price the market will bear that week. And that price can swing in ways you'd never see in any other kind of real estate. Take Montgomery Mall in North Wales, Pennsylvania. In 2014, it was appraised at $195 million. 7 years later, it went through foreclosure and sold for $55 million. That's a little more than a quarter of what it was worth less than a decade before on the exact same building. That's not even the extreme case. Triangle Town Center in Raleigh sold for $174 million in 2016. 3 years later, the lender took it back in foreclosure for just over $120 million. 2 years after that, it sold again, this time for $33,250,000. One building, 3 sales, each one lower than the last. Then there's Burnsville Center outside Minneapolis. When its owner filed for bankruptcy, the property went to auction. The winning bid on the debt, $18 million. The outstanding balance still sitting on that property at the time, $64,200,000. Listen to that again. The debt was more than 3 times the winning bid. In a normal market, a building's price and its debt roughly track each other. In the mall business right now, they can pull apart so violently that lenders recover a fraction of what they're owed and buyers pick up the rest for pennies. Which raises the obvious question. If you can buy a mall for pennies on the dollar, isn't that the opportunity? Berkshire Mall in Massachusetts answers that uncomfortably. It sold for $3.5 million in 2016. 3 years later, it sold again for $1 million. The price didn't just fall once. It fell by 2/3, twice on the same building. Meanwhile, at the top of the market, something completely different is happening. Simon Property Group, the largest mall operator in the country, closed out 2025 with occupancy at 96.4% across its malls and outlets. Tenants in those buildings are generating $799 in sales for every square foot they occupy. That is not a struggling asset. That is one of the best performing pieces of real estate in the entire retail sector. Same asset class, same word, mall, on the sign out front. Two completely different economic realities living inside it. And so before you spend a single dollar, you need to answer one question honestly. Which mall are you actually buying? A functioning Class A property with $500 or more in sales per square foot carries a vacancy rate of just 5.6%. Drop into Class C territory under $300 a square foot, and vacancy jumps to 13.3%, more than double. Those aren't two versions of the same investment. They're two entirely different bets, wearing the same zip code. One of them behaves like a bond. The other behaves like a lottery ticket with a parking lot attached. And the answer to that question determines almost everything that happens next, starting with where the money even comes from once the doors open. A mall doesn't make its money the way most people assume. It's not just the rent. It's 3 separate income streams stacked on top of each other, and almost nobody outside the industry knows the third one even exists. Let's follow one actual lease and watch what happens to the money. Say a handbag store signs for 1,400 square feet, base rent, $42 a square foot. That works out to $58,800 a year, paid whether the store sells one handbag or 10,000. That's stream 1. It's the only one most people think about. But most mall leases also include something called percentage rent. The lease sets a sales breakpoint, say $1 million for the store. Above that number, the mall takes a cut of every extra dollar the tenant makes. Say this handbag store does $1,240,000 in sales for the year. That's $240,000 above the breakpoint. At a typical 6% overage rate, the mall collects another $14,400. For doing nothing except owning the building the store happens to be successful in. Then there's the third stream, common area maintenance, or CAM. This covers cleaning the walkways, running the escalators, plowing the lot, lighting the corridors, and it's billed back to every tenant, split by square footage. At a typical rate of $9.75 a square foot, this one store pays another $13,650 a year, just for the mall to keep its own lights on. Added up, base rent $58,800, percentage rent $14,400, CAM $13,650, 1,400 square foot handbag store. Total paid to the mall, $86,850 a year. Now multiply that by 80 stores, or 120, or 200, all in the same building, all with slightly different terms, all recalculated every single year. Here's the part almost nobody mentions. KM charges aren't pure profit. They're supposed to be a pass-through. The landlord estimates the cost, bills tenants for their share, and reconciles the difference at year-end. But if the landlord manages that budget well, negotiates a cheaper snow removal contract, delays a repair, trims the landscaping schedule, the leftover margin becomes real income. It's not glamorous. It's a spreadsheet game, played one line item at a time, and across a building with 200 leases, it adds up to real money year after year without a single new customer walking through the door. Underneath all three streams sits a much bigger problem, the anchor problem. Anchor department stores, the Macy's, the JCPenney, the Sears that used to be there historically paid rent far below what smaller tenants paid per square foot. Sometimes almost nothing. The logic was simple. The anchor brings the foot traffic. Everyone else pays a premium to stand near it. The anchor was never supposed to be your profit center. It was your customer acquisition machine. Consider how lopsided that really is. An anchor might occupy 120,000 square feet and pay something close to $3.50 a square foot, a fraction of what the handbag store next door pays, for a space 85 times the size. That's the trade a mall owner makes without ever writing it down anywhere. Take almost nothing in rent from the biggest tenant in the building in exchange for everyone else agreeing to pay more to stand near it. It works beautifully for as long as the anchor stays open. Think about how strange that arrangement really is once you say it out loud. Your single biggest tenant, the one taking up more floor space than everyone else combined, is often the least profitable relationship in the entire building. You keep it around anyway, because without it, the smaller stores stop wanting to be there at all. And that assumption that the anchor keeps showing up is exactly what's been breaking over and over for the last 15 years. Almost nobody explains this before you sign the deed. There's a reason a fully leased, profitable mall can collapse within 18 months, and it has nothing to do with the economy. Everyone blames the same easy targets. Online shopping, Amazon, a generation that would rather scroll than drive to the food court. Those forces are real, but they move slowly, over years, not months. What actually sinks a mall moves in weeks. This isn't hypothetical. It's already happened over and over at a scale that reshaped the entire industry. In 2010, Sears operated roughly 3,500 stores. By the end of 2025, there were 5 left in the entire country. 5. JCPenney filed for Chapter 11 in May of 2020. Macy's announced it would close 150 stores, roughly a third of its footprint, and as of this year, that closure plan has stretched out through 2028. It's worth pausing on that last one because it's not a simple story of collapse. Macy's isn't just closing stores. It's pulling investment out of the weak ones and pouring it into a smaller group of stronger locations instead. Those upgraded stores are actually growing, which tells you something important. The mall isn't dying because the retailer is dying. It's dying because the retailer is getting selective about which buildings deserve to keep it at all. Here's what none of those headlines mention. Each of those closures didn't just leave an empty box the size of a grocery store. Somewhere in the fine print of dozens of neighboring leases, something else went off at the exact same moment. Then something changed. Not e-commerce, not Amazon, those forces move slowly. What actually did the damage was sitting quietly in the leases the whole time. It's called a co-tenancy clause. A co-tenancy clause sits buried in the leases of your smaller tenants, not the anchor, the stores around the anchor. It says something like this: if a named anchor closes or stops operating for a set number of days, the affected tenant can pay dramatically reduced rent or walk away entirely. Here's what that actually means. You don't lose one tenant when an anchor closes. You lose the rent from every tenant whose lease contains that clause all at once, the moment that anchor turns off its lights. Picture it happening in real time. One morning, the Sears sign comes down. By the following week, letters are landing in the mail from a dozen smaller tenants, all citing the same clause, all asking for the same discount or the same exit. You didn't do anything wrong. You just found out how many of your leases were quietly tied to one company's decision. It's a trigger you agreed to the day you signed the lease, and it can turn one anchor's bankruptcy filing into an instant building-wide collapse in rental income. This is exactly the kind of mechanism most owners never see coming, and exactly why we break one of these down every week. Subscribe, and let's look at what it's actually costing owners right now. The mechanism runs almost the same way every time an anchor closes. Co-tenancy clauses fire across the property. Rent income drops immediately, sometimes 30 or 40%. In a matter of months. The owner can no longer cover debt service. Loan covenants get breached. The lender accelerates the loan or forces a restructuring. What was, 18 months earlier, a fully performing asset ends up in foreclosure. And this is happening again, right now, in 2026. More than half of the roughly $100 billion in commercial mortgage-backed loans coming due this year are unlikely to pay off at maturity. Close to $25 billion in CMBS loans are already sitting past their maturity date, unresolved. The overall delinquency rate hit 7.55% in May, one of the newly delinquent loans that month, a regional mall in suburban New Jersey. Then there's the cost side, which never stops, no matter what the anchors are doing. Property taxes on a mid-sized mall commonly run $1.5 to $2 million a year. Insurance on a building this large can run another $250,000 to $400,000. A single HVAC replacement on a system serving a food court can cost $180,000. Roof repairs on an aging enclosed mall run into the millions, not the thousands, because you're not patching a house roof. You're resurfacing acres of membrane. None of that disappears just because your anchor left. The taxes still come due. The insurance premium still arrives. The roof still leaks, whether the building is 95% leased or 40% empty. This is what separates a mall from almost every other kind of commercial real estate. Your income can collapse overnight, contractually, the moment one tenant you don't even control decides to close its doors. But your costs never collapse with it. They just sit there, waiting to be paid by whoever still owns the building. So if the income can vanish in an instant and the costs never do, what exactly are you buying when you buy a mall? Here's the reframe it that once you see it, you can't unsee it. You don't own a shopping mall. You own a bet on which decade your anchor's balance sheet fails. And the lease you signed years ago already decided who wins that bet. It usually isn't you. A mall isn't really a retail business the way a restaurant or a gas station is, generating its own revenue from its own daily operations. It's closer to a financial instrument, a bundle of leases layered on top of each other whose entire value depends on a handful of large tenants continuing to exist. You don't control whether Macy's stays profitable. You don't control whether JCPenney's parent company decides your location isn't worth the lease anymore. You don't control interest rates or whether your CMBS loan gets refinanced on reasonable terms. What you do control is which leases you signed years before any of this happened, and whether those leases protect you or expose you. That decision gets made long before the ribbon cutting, and it quietly determines everything that happens after. Simon Property Group just proved exactly how much that difference matters. When Saks Global went bankrupt in 2025, Simon didn't just absorb the loss. It took back 38 former Saks Off Fifth leases that had been paying roughly $18 million a year, combined and released them for closer to $30 million. A 67% increase on space a bankruptcy handed back to them for free. Think about that for a second. A major department store chain collapsing is exactly the kind of event that triggers co-tenancy clauses and sinks a smaller mall overnight. For Simon, holding the strongest locations in the country, that same collapse became a raise. The space came back empty, and Simon simply filled it with someone willing to pay more. And it's not that one owner is smarter than the other in some general sense. It's that one of them is holding a portfolio so large and so diversified that no single department store's bankruptcy can sink the whole company. And the other is holding a single building where one anchor's decision determines everything. A mall isn't a business you run. It's a risk you inherit. priced by a market that's still figuring out what these buildings are actually worth. Compare that to a hotel or an apartment building or even a gas station. Those generate their own demand every single day. One customer, one fill-up, one night's stay at a time. Nobody can sign a piece of paper that instantly cuts a hotel's revenue by 40% overnight. A mall's revenue can move that violently in a single quarter because so much of it is contractually tied to decisions made in a boardroom hundreds of miles away by people who've never set foot in your building. That's the uncomfortable truth sitting underneath every glossy brochure about mall ownership. You're not buying square footage, you're buying exposure to corporate balance sheets you'll never see, governed by lease language you probably won't fully understand until the day it gets triggered against you. And once you understand that, the whole industry starts to make a strange kind of sense, including the people who've figured out how to profit from exactly this kind of collapse. Here's the uncomfortable part. The person who profits most consistently from a dying mall usually isn't the person who tried to save it. Meet Mike Cohan. Based out of Great Neck, New York, he runs a company called Cohan Retail Investment Group. As of last count, it owned 28 mall properties across 19 states. Almost none of them are healthy, and that's the entire point. Cohan's pattern started after the 2008 financial crisis, when distressed malls began flooding the market at prices nobody else wanted to pay. In 2012, he bought Lincoln Mall in a foreclosure sale for $150,000, not $150 million, $150,000 for a fully enclosed shopping center, because the previous owners already owed millions in unpaid fines and taxes, and nobody else was bidding. You already know what happened with Montgomery Mall, Triangle Town Center, and Berkshire Mall. The pattern behind every one of these deals is almost never described honestly in the press. First, buy at land value, not income value. Cohan isn't underwriting these deals based on what the mall currently earns in rent. He's underwriting them based on what the dirt and the building shell are worth if the retail business inside them fails completely. That's why he can pay $150,000 for a building that costs tens of millions to construct. The deal only needs to make sense, assuming the mall itself is worthless. Second, don't chase a retail turnaround. Most buyers of a struggling mall talk about repositioning it, adding entertainment, adding housing, adding a clinic in the old Sears box. Cohan's properties rarely get that kind of reinvestment. One retail consultant described his business model as the last owner a mall ever see, the final stop before a building's retail life effectively ends. Even the cleaner exits aren't guaranteed. When JCPenney went through bankruptcy, the trust holding its old real estate lined up an almost billion-dollar deal to sell off 119 former store sites to a private buyer. That deal was supposed to close in late 2025. It fell apart instead. The buyer simply didn't complete the purchase, and those properties are still sitting in limbo. Even selling the dirt underneath a dead store isn't the safe bet it looks like from the outside. Third, extract value by breaking the property into pieces, rather than operating the mall as one asset. The strategy often means subdividing the parking lot and selling off out parcels, the standalone lots along the edge where a bank branch or a drive-through might sit, separately from the enclosed mall itself. Burnsville Center is a clean example. Within less than a year of that auction purchase, the 47-acre property was subdivided, with a plan to sell individual out parcels to repay investors, even while the enclosed mall kept struggling. Fourth, and this is the uncomfortable part to say plainly, keep operating costs as close to zero as the property will tolerate. Multiple Cohan properties have faced unpaid tax bills, utility shutoffs over unpaid electric bills, and code violations tied to deferred maintenance. This isn't a side effect of the strategy. In a business built around minimizing reinvestment in a declining asset, it's close to the strategy itself. Fifth, and this is the part that actually makes the arithmetic work. Move fast and don't get attached to any single property. Malls in this portfolio get bought, held a few years, and sold again, sometimes for a gain, sometimes just to exit a property whose local government has run out of patience over unpaid taxes. It's less like running shopping centers and more like running a numbers game where the buildings are the chips. And here's the twist that actually completes the story. Even Cohan doesn't hold forever. In late 2024, Triangle Town Center, the same mall he bought for $33 million, sold again, this time to Summit Properties USA as part of a $700 million deal covering several malls at once. Montgomery Mall is now co-owned the same way. The last owner a mall sees isn't always the last owner after all. Sometimes he's just another link in a chain, cashing out to whoever's willing to make the next bet. This isn't an inspirational story about someone who saved a dying business through grit and hard work. It's something more honest and more useful. Proof that in an industry where the retail model is genuinely breaking down, the money isn't made by running the mall better. It's made by correctly pricing what's left once the mall stops being a mall at all. It also explains something that confuses most first-time buyers browsing these listings. Why would anyone pay $150,000 for a fully enclosed shopping center? Because the buyer isn't valuing it as a shopping center. They're valuing the land, the parking acreage, the utility hookups, the zoning entitlements, the pieces that survive even if every storefront inside goes permanently dark. Once you stop pricing the retail business and start pricing the real estate underneath it, deals that look insane from the outside start to look almost conservative from the inside. Which is exactly what shows up when you run the actual numbers. Let's close the loop with two real scenarios, built from real numbers. Scenario 1. The traditional path. You buy a 620,000 square foot regional mall for $46.8 million. That reflects an 8.4% cap rate on its current income. This mall still has 2 working anchors and roughly 81% occupancy across its inline space. Annual base rent across the leased space, $11,940,000. Percentage rent from your better performing tenants adds another $612,000. KM recoveries bring in $4,380,000, covering most, but not all, of your actual maintenance costs. Total revenue, $16,932,000. Now the costs. Actual KM expenses, the real cost of running the common areas, including the vacant space the landlord absorbs, run $5,240,000. Property taxes, $1,780,000. Insurance, $365,000. Management fees at 4% of revenue, $677,280. Marketing, admin, and leasing commissions, $410,000. Total operating expenses, $8,472,280. Net operating income, $1,459,720. Against your $46.8 million purchase price, that's an 18.1% unleveraged return, which sounds excellent until you account for the debt. Here's where the leverage comes in. Finance 65% of the purchase at 7.4% interest on a 25-year amortization, and your annual debt service runs approximately $2,640,000. That's the bank's cut, paid whether the mall has a good year or a terrible one. Subtract that from your net operating income, and cash flow after debt service comes to roughly $5,819,720 against equity invested of $16,380,000. That's a 35.5% cash-on-cash return on paper, but it assumes your anchors stay open. Your occupancy holds at 81%, and no co-tenancy clause ever fires. Now run the same mall through one bad year, one anchor closes. Co-tenancy clauses fire across 22 inline leases. Occupancy falls to 58% within 18 months. Your annual revenue drops by roughly $4.9 million. Your net operating income falls below your debt service. You're covering the shortfall out of pocket or negotiating with your lender from a position of weakness. Change one assumption, and the entire calculation collapses within a single fiscal year. That's the trap in Scenario 1. The return looks extraordinary right up until the day it doesn't. Scenario 2, the Kohan model. You buy a 650,000 square foot dead mall. One anchor closed, occupancy at 34%. Purchase price, $6.2 million, down from a previous appraised value of $58 million. You don't renovate, you don't chase new retail tenants. Your only meaningful expenses are property taxes of $410,000 a year, insurance of $95,000, and minimal security and utilities, another $340,000. Rental income from the handful of remaining tenants, $1,850,000 a year. Subtract your $845,000 in annual costs, and your operating cash flow is $1,005,000 a year, a 16.2% return on your purchase price just from what's left of the retail operation. But here's the number that actually changes everything. In year 2, you subdivide 4.2 acres of surface parking along the edge of the property and sell it to an out-parcel developer for $3.1 million. That single transaction is exactly half of what you paid for the entire mall. Add the out-parcel sale to 2 years of operating cash flow, and you've recovered $5,110,000 against a $6.2 million purchase price in 24 months. And you still own the mall itself, the remaining anchor boxes, and whatever's left of the parking lot. The traditional mall might return more on paper in a good year. The Kohan model returns your capital faster with a fraction of the downside risk because you priced the deal assuming the retail business was already dead. And when retail businesses this fragile keep dying at the rate they have been, that assumption keeps being right. The American shopping mall was never really a retail business. It only looked like one for about 40 years, when the anchors were healthy and the co-tenancy clauses sat quietly in the leases. Never triggered. Those 40 years are ending. 87% of what's left may not survive the next 10. But the buildings themselves aren't disappearing. The land underneath them is some of the best located real estate in thousands of American towns. Close to highways, close to housing, already zoned for commercial use. What's disappearing is the assumption that a mall's value comes from what happens inside it. For decades, that assumption was so obvious that nobody ever bothered to question it. Now it's become the entire question the whole industry is trying to answer. The business you think you're buying is a shopping center. The business you're actually buying is a bet on someone else's balance sheet, wrapped in a 100-year-old lease structure built for a version of retail that no longer exists. Some people are figuring out how to price that bet correctly. Most owners still aren't. And the gap between those two groups is only getting wider. One anchor closure, one foreclosure, one auction at a time. You've walked through 100 malls in your life. The question now is whether you understand what's actually holding the building up, or whether you're still just admiring the floors the way you always have. And that's really the whole point of this channel. Every business looks simple from the outside. The diner, the gas station, the mall. It's only once you open up the numbers that you see what's actually holding it together. If you want to keep doing that, subscribe, because we're breaking down a new one every week.